Welcome back to another episode of the Enrich Your Journey podcast. I'm your host, Patrick Monahan. We are here on episode 17. Got with me a gentleman I've known for probably close to 10 years now.
Easily-ish.
I
think we first met in 2011.
2011. Okay, there you go.
Yeah.
So we're going on 14 years.
Yeah, you've aged well.
Thank you. Likewise. Dennis Cooper. I'll introduce Dennis, his bio here, and then get into today's topic, which I'm deeming leveraging a critical asset for retirement needs. So Dennis is a graduate of Thiel College in Pennsylvania, did some grad work at Kent State University, has 2 grown sons and 1 grandson. Is that still accurate? Okay.
Yep.
And he is also a veteran of the Air Force. So thank you for your service.
It's what we did.
I love it. Dennis has 25 years experience in insurance and financial planning, the last 15 plus focusing 100% of his efforts in assisting active adults in understanding and properly utilizing the equity in their homes to reach their retirement goals. Dennis is a vice president with the Federal Savings Bank in the Home Equity Conversion Mortgage Division. He's also very active in the community. I know he's part of many organizations, Breakthrough Coalition, Senior Services Task Force, St. Louis Care Alliance, various senior resource teams. He's also been a part of 7 chambers of commerce and the Financial Planning Association and the St. Louis Association of Realtors. Somehow he still finds time to golf, as he mentioned, every once in a while with all those.
Important.
So Dennis, thanks for being on the show. Appreciate your time.
My pleasure.
How'd I do? Did I miss anything critical?
I'm also on the board of Aging Ahead. We do Meals on Wheels, and we have 15 senior centers we support around St. Louis. And I'm on the board of something called the Kaufman Fund. We're a veteran charity. We have 8 different services that we provide to veterans: legal, dental, chiropractic, art, food, you name it, we do it. And the thing we're famous for is giving out Christmas trees at Christmas time.
Oh, that's cool.
Yeah.
That's awesome. Well, thanks for adding those. Sorry I missed those. So let's get into it. The topic today, again, is home equity conversion mortgages. Dennis is absolutely an expert in this topic, well known in the St. Louis area where we're coming to you from today, from Trilogy headquarters. And so it just really, this topic actually, ironically, has come up with a couple of folks with me after we had this booked. And so the timing's good. I think, the theme continues where we've got a lot of baby boomers retiring. This market probably will continue to grow. And so I thought this would be a great topic to bring to you all today. As always, likely more of an introductory type format, but we can get into the weeds a little bit. So I'll start as I always do, and then again, kind of turn it over to Dennis. Want to get his input on this, obviously, with really just reading to you what the definition is of a home equity conversion mortgage. So a home equity conversion mortgage, HECM, is a reverse mortgage loan that's insured by the Federal Housing Administration, which is part of the Department of Housing and Urban Development, or HUD. Home equity conversion mortgages allow seniors age 62 and older to tap their home equity without selling their property, and that's the big one there that we'll touch on. These mortgages are most common. They're the most common type of reverse mortgage loans. So, Dennis, I'll kind of turn it to you. Let's get into what I call the meat and potatoes. Really, how do these work? What are some of the requirements? And with your expertise of doing this over 15 years, what do you see that are really the biggest advantages for folks considering these or actually applying for them?
Basically, you and I were talking earlier, and I told basically when I was doing financial planning, you would go to work at 20, you'd work to 62, and retire at 62, and perhaps pass away at 82. So you had 40 years to accumulate enough money to support yourself for 20 years of retirement. Well, the problem with that is today, people are easily living to 92 rather than 82. Where's the money come for the extra 10 years? The money that you thought you were going to pass on to the next generation, perhaps you're using to continue through retirement. Most Americans, homeowners, have equity they build up in their home, completely untapped. If you want all of your assets to be working for you, why wouldn't the equity in your home work for you? And this product gives you access to that equity you build up in your home on a tax-free basis. With the choice, you never have to make a mortgage payment as long as you live in the home. So in essence, you have cash flow that you never thought you had. You have a $500,000 house. At 62, probably lend at least $200,000 of tax-free money available. There's several different options. You could take it as a lump sum. You can take it as a line of credit. You could take a tenured amount for either, say, 10 years or a lifetime, if that's what you want. One of the neat things about the line of credit, probably 98% of the people I do reverse mortgages for use the line of credit option, because one of the things that people don't realize is with the line of credit we have, we guarantee right now the line of credit will grow by 6 to 7% a year. Well, the rule of 72 tells you if you can get an increase to your money of 6 to 7%, your money doubles. So if you did a line of credit at 62 and I can get you $200, but $200,000, and you decided not to touch it, at 72 you'd have a $400,000 line of credit. If you can wait till you're 82, you've got $800,000 of tax-free money from your house. Your house may not be worth that much. Yep. So it's a really neat use. I talked to a lot of people about those individuals that elected not to get long-term care insurance. Why not build an asset that you could utilize for the long-term care? Because that's one of the things we're all facing. If we live long enough, you're going to need help.
And we know those expenses of long-term care are growing dramatically, right? As you mentioned earlier, people are living longer. And so that formula right there can pose to be a real challenge for a lot of residents.
The reason people are living longer is quite simply medical care, medical assistance, home health aides, all of that goes into the situation. Those things aren't cheap.
Right.
Where does the money come from? So
right. Big part of this too, I'm glad you touched on that, is, obviously, as financial planners, financial advisors, taxes are always at the top of our list with concerns and challenges from clients. So I'm glad that you mentioned it's tax-free. That's a big component of it. And it's a simple concept, right? A 30-year mortgage, you made your mortgage payments over 30 years with after-tax dollars, right? You're paying tax. If your mortgage is $3,000 a month, that $3,000 a month is after-tax money.
Right.
So that's a big component of tapping into this equity in a product like this. These can be, if you choose the lump sum option, these can be pretty large sums of money that you don't have to factor in the tax challenge. Right.
And depending upon how you want to use the money, if you know your line of credit, the unused portion of the line of credit is going to grow by 6 to 7% right now. Where are you going to take that lump sum and put it? Guaranteed 6 to 7%. So a liquid line of credit flows really easy from the equity in your house into your checking account when you need it. And when you don't need it, it sits there growing for you. So,
yep. Interestingly, one thing I noticed when I was researching the topic, these aren't all necessarily small loans, right? I actually saw for this calendar year, you can actually take up to $1.209,750 on a home equity conversion mortgage.
Some government official came up with that number.
Right, yeah. Kind of a random. But I'm curious, though, in your experience, because I know you've underwritten many of these, when would it make sense? I guess you really would just calculate, what the delta is if you wanted to tap into $1 million equity of your home. If you believe the market or anything else you can take with that asset and go produce greater than what the cost is of these loans, there's probably a market there. Maybe it might be a smaller market, but the whole idea of this is you really have, what I call a dead asset, right? It's just equity sitting in your home. And you look at, we didn't even talk about what real estate values have grown the last even just 5 years.
I'll give you an example. I bought my house back in 1989 for $145,000. Today it's worth $509,000. One of the best investments I made in my life.
Yeah.
So, and that's not uncommon at all. If you look at the value of houses today, and another thing about the reverse mortgage, if you do a reverse mortgage today, say your house is worth $500,000, and I give you a line of credit of $300,000, and the value of the house goes down, your line of credit's still at $300,000.
Yeah,
so
that's good.
It's another factor people don't realize.
That's good. Let's talk about the requirements.
Okay.
So there's an age requirement, and then some of the things that you need to have in order before you would even consider looking at this type of product. Can you just review those for us?
Well, the basic HECM home equity conversion mortgage product, at least one individual on the home has to be at least 62 years of age or older.
Okay.
It used to be everyone on title, everyone in the reverse mortgage had to be 62. And I get these calls from guys who just turned 62 with a 42-year-old wife. that would cause problems.
Yep.
But today, as long as one of them is 62, the younger one can be less than 62. You have to have homeowners insurance. You have to pay your property tax. You have to keep the house up to normal standards. People worry about that. We really don't have a reverse mortgage police going around the countryside looking at houses.
Right.
Typically, if you got a problem with your homeowner's insurance, that keys in that maybe you need to fix something up in your house.
Sure.
But those are the real responsibilities. You have to have enough equity to pay off any mortgage you have, which recently has caused a problem because 2.5 years ago, people refinanced for 2% rates.
Yeah.
That meant they had a nicer rate, but the value of their mortgage increased to the point where now that interest rates are higher, it's difficult for us to generate enough money to pay off that mortgage. So you do have to pay off whatever mortgage or lien you have in your home. The reverse mortgage has to be the only loan on the house. You can't do a HELOC after you do a HECM.
Got it. So that's important. Okay.
Yeah.
So one loan total on the house.
Right.
No secondary.
Right.
Okay.
But, I've run into people all the time who lived in the house for 30 years and their mortgage is paid off. They might have to pay off a $10,000 HELOC. But, the nice thing about the HECM as opposed to a HELOC is if you have a HELOC in 5 years or 10 years, you're going to get hit with a rate increase.
Right.
And if you're at a sufficient age, you may not be able to qualify for a HELOC. With a HECM, the older you are, the more we are willing to work with you. It's like an annuity compared to a life insurance product.
Yep. Yep. That makes sense. Yeah, because HELOCs are, typically there's much shorter time periods with a fixed rate. A lot of banks, particularly credit unions, will have what we call a teaser rate, where if you open a HELOC, they might get you a very favorable rate for 12 months.
Yeah.
Right. And after 12 months, it's going to go to a variable index, maybe plus a spread, to where you're, today, you could be easily 8+, 9+% on a HELOC, right?
And that can come as a real surprise to people. So.
Right. What type of properties? Obviously, I would imagine single-family homes are probably the lion's share of it.
Yeah.
But the HECMs do apply to other types of properties, correct?
Yeah, we do modular homes, not mobile homes, but modular homes. We do condos, villas, townhomes, site condominiums, duplexes, triplexes, fourplexes. I mean, if you want to do a reverse mortgage and you're living in one of the units and you do a reverse mortgage on a fourplex and 3 of the houses are paying you money each month for rent, it's a great use of a reverse mortgage, especially as you get older. It helps you finance another income. So.
Yeah. Okay. So not just single. So really, to me, it seems like there's a lot of flexibility with designing the product. It can be very tailored. Is that fair?
Yeah. I view my job as listening to what the client has to say, find out what their concerns are. I provide them with options. And if it makes sense for them, fine. If it doesn't make sense, I actually taught people out of doing reverse mortgages if it didn't make sense. Yeah.
That's good. And I can attest to that, just knowing Dennis for years and working with him. Ethical standards is a big part of your practice. And obviously when you're lending money, that's a big part of the overall underwriting process.
Oh, yeah,
you got to make sure it one size doesn't fit all, and it may not be appropriate for everyone. Right. If they have means elsewhere, maybe it doesn't. Right. Let's talk about, some of the repeat viewers know I love talking about stats to kind of build the case. Let's talk about just the demand of these products and statistics. One I looked at was it's a pretty small market compared to other options, and I'm curious to get your opinion on why you think that may be. The most recent data I could find, this is according to the Urban Institute in 2018, so a little dated. In that year, there was about 48,000 home equity conversion mortgages underwritten compared to 1.2 million HELOCs opened that year.
Yeah.
So I'm curious why you think that disparity is so large. Obviously HELOCs apply to everybody. There's not that age requirement, so that could be part of it. As we mentioned earlier, values have gone up in homes, but is it just sheer market-wise that maybe HELOCs apply to younger generations, or do you think it's just a lot of people, one thing we were talking about off air before we started was a lot of people think, reverse mortgages sometimes have a bad rep.
Yeah.
Right? So I'm wondering if maybe it's a combination of all those. When you hear, less than 50,000 compared to 1.12 million in one calendar year, there's a significant variance there. I'm just curious, maybe an opportunity to share some of it might be just the educational part.
And truly, that is the biggest thing. People ask me, what's the hardest part of my job? It's overcoming misinformation. Historically, people were always concerned that the lender would take the house. And initially, 41 years ago, when this product was developed under Ronald Reagan, for those of you who are conservative lean, the product was developed and the lender's name went on the title for about 6 months until they realized what they'd just done.
Right.
And the title stays with the homeowner, not the lender. The lender has no access to that. I think that's one of the hardest things for people to overcome. And if you're a senior, so many seniors tell me, well, I want to leave the house to my kids. Well, let's think about that for a second. Do your kids really want the house? Your son's living in Massachusetts. You're living here in St. Louis. You pass on. First thing he has to do is come into St. Louis, clean out the house, bring it up to market in order to get money out of it. Quite frankly, your children would rather have money than a house.
Sure. Yeah.
And quite frankly, I always talk to the children so they understand what's going on. And I explain to them, would you rather help your parents financially now so you get the house later? Or would you rather your parents be self-sufficient now and you get what's left later? No matter how much you love your parents, you're saving for your retirement, you're saving for your kids' college.
Yeah.
In some cases, you're saving for a tank of gas. We'll soon find out how that works.
Right.
But no, I mean, there's probably a lot of still misinformation out there. And my job is sort of overcome that through education and explain how this product really works and all the things it can do for people.
And one of the ways you do that, and I've seen this multiple times from you, is creating what we call an illustration that's really going to show, line by line of how this thing works, right?
Yeah.
So this is not, this does not go into a black box. Every person that meets with you and gets an estimate done or an illustration, it'll show you line by line what's the cost, how does it work, what are the exemptions or rules to these things, and so that part of it being so critical so that they understand before they make a decision. There's no obligation to do these, right? Like just running these quotes, these illustrations for many people so that hopefully they can go back, understand the product enough to make an educated decision. And that's what we want.
And another thing is it's the only mortgage product I know that the client has to have mandatory counseling from an independent HUD-approved counselor before they even do an application. That's the first step. Once you have the counseling, and you pass the counseling, we get a certificate that shows you passed it. We can then do the application. I tell people all the time it takes between 4 and 5 weeks to actually close from the time you've had your counseling to when we come together and use a notary to close the loan. I have had situations where families have tried to take advantage of the senior and do a reverse mortgage so they could get the money. Mm-hmm. The counseling, in many cases, perhaps the senior isn't quite competent enough to actually understand what they're getting involved in.
Sure.
This eliminates that. So we're protecting the senior from being taken advantage of by family members or others to access that equity that they build up in their home. So,
do you see a demand here? Another thing we were talking about offline is just, and I've mentioned this on other episodes too, this is a hard stat to believe, but 10,000 baby boomers retiring every single day in this country.
Yep.
Do you see this product in the very near future having high demand just because of the sheer number of clientele? You mentioned earlier, every day you have 10,000 new potential clients, right?
Right.
We mentioned earlier that the retirement, the minimum age is 62. Most of the average age of these baby boomers retiring is 65.
Right.
So I would imagine just sheer law of large numbers, this product probably is going to be in high demand in the near future. Would you agree with that?
It's going to be in high demand for at least the next 12 to 15 years when generations pass through the different age portals. It's a product whose time has come and will continue to be there. If you talk to the normal baby boomer, they want to stay in their house as long as possible. Well, this product in many cases will allow them to do that. Ultimately, if you live long enough, but I've had clients. I had one client who was 94 years old. His mind was sharp as a tack. He had 2 engineering degrees. He had 94 patents that he created, including the car seat warmers. But the thing he was proudest of, he was America's oldest soapbox derby driver, When he was 12 years old, he won the Soapbox Derby in New York. All of the things he's done in his life, but the thing he was proudest of is he was America's oldest Soapbox Derby driver.
That's great.
The people I deal with have so many stories.
Cool stories. Yeah, that's neat.
Yep.
Let's touch on, we kind of briefly touched on it, but just briefly the process. So somebody's watching this right now, and it's either them directly, or maybe it's their parents or their grandparents, somebody they know that say, they've had a pretty nice house for a long time. I know they've been, paying down the mortgage. Maybe it's paid off. What does that process look like? We want to, you obviously want to try to keep it as painless as possible.
Right.
But just what are the few steps that really are involved or required to get this thing over the line?
Well, as I said, first thing is you have to have the counseling. If there's two people in the title, both of them have to have counseling. If one of them is not quite competent enough, their power of attorney can do it, their guardian can do it.
Sorry, who's running the counseling? Is that
counseling? It's actually typical counseling agencies that have been approved by HUD.
Okay,
nationwide.
So those are easily accessible.
Yeah, the counseling in most states is done by telephone. It's just a lot more comfortable. There aren't enough physical agencies. But when I do an illustration, as you mentioned, typically I give them a list of about 10 different counseling agencies that they have to call. I can't instruct them as to, you
which
need
one
to do this one. They have to call. They have to schedule it. The counseling agencies vary in cost from anywhere from like $150 to maybe $200. Some of them will waive that fee if the individual doesn't have that much money. Others will make the counseling fee part of the closing cost, so you don't have to pay that up front. Once the counseling is done, we do an application, file the application. Our company contacts a title company, who then contacts an appraisal company, and the appraisal company will have one of their appraisers call and go out. It takes about 15, 20 minutes. They'll take pictures inside and outside, go back to their office and create an appraisal based on comparisons of houses that have sold in that geographic area of similar work.
Yep.
Once that's done, we get the appraisal back. It goes into underwriting. We have all the submission documents we need, like driver's licenses and property tax statements, things like that. The typical, as I said, takes 4 to 5 weeks to get from the counseling certificate to closing. I arrange for a notary to come out with me, and we go through it. The notary's there to witness signatures. I'm there to answer any questions, but by this time, my clients usually know the answers to all those questions.
Yep.
3 days after closing, they can have whatever money they want. I typically tell them to take a little bit out if you don't have other needs, so it carries forward, because it takes about 30 to 45 days to set up the electronic transfer from the lender to your checking account.
Okay.
But after that, it's up to you. You contact whenever you need money. It goes directly into your checking account. You write a check right off your checking account. So
okay. So it sounds like the middle part of the process is the same, really similar to just the traditional mortgage.
Exactly.
Right? You're getting the title work, obviously applications, you're getting the appraisal done, you're getting probably maybe do you have to do an inspection? Home inspection?
We don't do it, just an appraisal.
Okay, just appraisals. You're saving a step there. So the 4 to 6 week turnaround time is pretty similar to just a traditional buying.
I tell people all the time, I did one in 12 days, which was exceptional. I also did one in a year and 3 months, which it included 2 judges and 3 divorce attorneys. So great divorce is real.
So there's your guardrails, 12 days and over a year.
Yeah.
That's helpful. So let's talk. We've talked about a lot of the advantages, right? Tapping into a dead asset, pretty user-friendly process. Let's talk about, the product itself. Some of we'll call them challenges, right? This is not a free product. So let's just talk about kind of if there are any disadvantages or challenges, what may those be?
Typically, when I do a seminar, I usually ask for a show of hands. How many people have heard something negative about a reverse mortgage? And since Tom Selleck started working for the industry, less people have questions. But still, there's always a question of why is it more expensive than a conventional mortgage? And I agree with him. It is more expensive, but it's a fully insured loan. It's the only mortgage product I know that's fully insured to protect your heirs. So, I mean, that's one of the big difference in cost. Everything else is pretty much the same as conventional mortgage, HELOC. We have an origination fee, which I have seen ability to lower based on lender credit. The assurance is the biggest piece, though. That's the one that costs the most money.
Okay.
But there's a good reason for it. Have you ever gotten insurance and not paid for it?
Sure.
Yeah,
Right.
so.
Right. And the costs, can those be deducted from the loan itself?
Oh, yeah.
Okay.
Typically, well, almost 100% of the time, that's part of the closing cost. That becomes part of your loan.
Got it. So if you want to do all this without actual out-of-pocket expenses,
Yeah, the only
obviously you're tapping in your equity.
Yeah,
but
the only two things that you would have to do is if the counseling firm won't make their cost part of
Their
closing
own
cost,
fee.
you have to pay that, and you have to pay for an appraisal fee. And people always say, "Well, can I make the appraisal fee part of the closing?" No, because if you don't go through with it for one reason or another, we're left holding the bag, and that could get expensive
Sure.
after a while. So
sure. And you've never seen any issues with, again, the one that the second hand, the first hands are always, what's the cost? The second hands are always, can I lose my home? Can you just touch on that?
yeah, for some reason, seniors still seem to think that the lender wants to take their house, and I tell them we don't have a warehouse to store houses. We're lending money. We want money paid back. But seniors, for some reason, seem to think the lender's going to take their house, and I always tell them, it's not that the lenders are nice people. The longer you stay in your house and you don't make any payments, interest accrues and your balance goes up. That's why it's called a reverse mortgage. The lender's going to make more money the longer you stay in the house. Why would the lender ever take your house? The lender will work with you to stay in your house simply because they're going to make more money, either from the heirs or from the heirs in the insurance. I'll give you an example. Real simple. Let's say it's a $200,000 villa. And if you do it at, let's say, 62, and you live past 82, so you've got like 20, 25 years of interest accumulated on this loan, and somehow the loan grows to $250,000, but the villa's only still worth $200,000. You leave the villa to your heirs because you're the only ones on it, and it's your property. Your heirs sell it for $200,000. They would owe $190,000. 95% of whatever they sold the house for. Difference between the loan balance of $250 and the $190 the heirs pay comes from the insurance that's built into the product. The heirs can't lose money. At worst, they're going to owe 95% of whatever they sell the house for. So, as I said, the lender's either going to get paid by the heirs or get paid by the heirs in the insurance. If there's equity left in the house after they pay back the reverse mortgage, the heirs get it. So
that's a huge part of it too. So if you are underwater, the heirs cannot lose money.
correct.
Right?
Correct.
That's a huge piece of it because mom and dad, or dad only, or mom only, or aunt and uncle, whoever, last thing they want to do is put the heirs in a situation where as soon as they pass away, they're in debt. Right?
And, I saw an article, actually I questioned the article this morning. Someone said you have to sell the house. You don't have to sell the house. I worked with a family that had lived in the home for 3 generations and they wanted to keep the house. You pay it out of cash. You do a conventional mortgage to pay off the reverse mortgage. You do a reverse mortgage if you're old enough to pay off the reverse mortgage.
Sure.
So, one doesn't have to lose the house. It's
You just got to come up with you come up with a new loan for the next generation that's going to buy it.
The same thing if you had a conventional mortgage or a HELOC on the house and you passed away, you'd have to you'd have to refinance, reverse, or that conventional mortgage. So,
Yep. That's good. Well, this has been great. Hopefully, really, really good information for you all. I would say the calls to action. If this is you, that you've got good equity, you could potentially use more cash flow for retirement income needs, or somebody else out there, just make sure that you do your research. Just learn the basics of it before you start talking to anybody. I'll include Dennis's information in the episode. I know he's very easy to get a hold of, and typically if somebody's requesting the illustration, is that a pretty quick turnaround time meeting and with them?
If I get the right information, I can crank out an illustration in about 10 minutes and email it to either the individual or the family member.
Okay. And you can do those virtually, I assume, too, if it's a phone call or email. It doesn't have to be an in-person meeting.
No, I'm certified in all 50 states, and I've done reverse mortgages in 17 of those states, including Hawaii.
Okay.
I was contacted about this 3-bedroom, 2-bath house in Hawaii on the Big Island, And it wasn't in the greatest shape in the world. In St. Louis, it'd go for 250, 200, $1.4 million.
Wow.
Yeah, it's...
Now, is that one where you had to make sure you had to do a site visit? You know,
I'd like to, but it was a little expensive to make a site visit.
right.
Yeah.
Well, that's good. Well, again, do your research. Please feel free to reach out to Dennis. You know, he is an expert in this field. He's been great to work with. Our firm's done a lot of business with Dennis over the years, and you know, he will shoot you straight if it's an appropriate product for you to consider. You know, as he stated early on in the episode, if it's not, you know, he will make you aware of that.
Yeah.
And I can attest to that. So, Dennis, really appreciate you coming on. It's good to see you.
My
Thanks
pleasure.
again for your service, as always, and thank you for joining us, and we'll see you on the next episode. Take care.